Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Welcome back to the channel, traders and investors. Today, we're diving deep into a fascinating microcap stock that has popped up on our hard-to-borrow screener, Joncho Inc., ticker symbol ZCMD. We're going to dissect why this stock is drawing attention, what its sky-high cost to borrow means, and the unique factors that could influence its future price action, including the very recent reverse stock split. Shows the ZCMD chart. Let's start with a quick overview of Joncho Inc., ZCMD. This company operates in the healthcare/health information services sector, providing healthcare information, education, and training to professionals primarily in the People's Republic of China, under its Endemic brand. It's a very small company with a market cap sitting at just $2.04 million. Looking at recent price action, ZCMD has been a roller coaster. Today, it's down about 8.4%. However, zoom out a bit, and over the last 5 trading days, ZCMD is up a staggering 96.19%. But look even further back, and over the last 30 days, the stock is down 98.45%. Volume-wise, today saw 1,427,448 shares traded, which is significantly below its 30-day average volume of 3,421,488 shares, giving it a relative volume of about 0.4 times average. What is cost to borrow and why it matters? So, why are we talking about ZCMD today? It's all about the cost to borrow. For those new to short selling, when you want to bet against a stock, you borrow shares from a broker, sell them, and hope to buy them back later at a lower price. But borrowing those shares isn't free. There's a fee called the cost to borrow, or CTB. This fee is typically annualized, and when it's high, it tells us a few things. Either there's huge demand to short the stock, or there's a very limited supply of shares available to borrow. And yes, these fees can absolutely exceed 100% annualized, meaning it costs more than the stock's value per year just to hold a short position. Why this stock is hard to borrow right now? Now let's talk about ZCMD specifically. The stock is currently flashing bright red on our hard-to-borrow screener with an annualized cost-to-borrow fee of an astonishing 745.8%. To put that into perspective, that's incredibly expensive. What's more, the CTB fee has seen significant momentum, increasing by 31 percentage points over just the last 5 trading days. The supply side is also critical. There are currently only 9,000 shares available to borrow. When you compare that to ZCMD's estimated float of 1.1 million shares, you can see why borrowing supply is incredibly constrained. Our internal composite squeeze score for ZCMD, which combines CTB level, momentum, borrow supply, float size, volume, price momentum, and technical setup, currently sits at 42.2 out of 100. Show CTB data on screen. Squeeze mechanics explained. So, what does a high cost to borrow mean for a potential short squeeze? Imagine short sellers betting against ZCMD. With a CTB fee of 745.8%, they are paying an enormous daily premium just to maintain their position. If the stock price starts to rise, those short sellers are not only losing money on paper, but they're also incurring massive daily fees. This pressure can become unbearable. To stop the bleeding, short sellers are forced to cover their positions, which means buying back the shares they initially borrowed and sold. This forced buying creates demand, pushing the price even higher, which, in turn, can force even more short sellers to cover, creating a rapid upward price movement known as a short squeeze. It's a feedback loop. However, it's crucial to understand that a high cost to borrow does not guarantee a squeeze. It can also indicate that short sellers have very strong conviction that the price will ultimately fall, and they are willing to pay a premium to maintain that bet. Dilution risk check. Before getting too excited, we always run a dilution risk check. For ZCMD, recent SEC filings show registration statements -1/-3/424B within the last 90 days. This is a flag for potential dilution. In simple terms, this means the company may issue new shares to raise capital. If new shares are issued, it increases the total number of shares available in the market. This added supply can dilute the value of existing shares and, critically for a squeeze thesis, it can provide more shares for short sellers to cover their positions with, or for new short sellers to enter, thereby offsetting or even negating the upward pressure from a short squeeze. Recent reverse split watch. Another critical factor for ZCMD is its very recent reverse stock split. John Inc. executed a 1-for-3 reverse stock split on June 29th, which was just 8 days ago. A reverse split reduces the number of outstanding shares and, proportionally, increases the share price. For example, if you had 3 shares at $1 each, after a 1-for-3 split, you would have 1 share at $3. Historically, with many microcap stocks, we observe a pattern where they can see renewed volatility or a price pop within about a month after a reverse split, as the share count is reset and the price moves higher. While this is an observed tendency in some microcap names, it is a pattern, not a guarantee or a rule. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you watch for with ZCMD? Keep an eye on the cost to borrow data. Does it continue to climb, and does the borrowable share supply continue to shrink? Watch the volume and price action. Can ZCMD sustain or build upon that recent 96.19% 5-day gain? Any significant increase in buying volume relative to its 30-day average would be a key indicator. Also, keep an eye on news regarding any potential dilution events from those recent SEC filings. Finally, consider the pattern we discussed regarding post-reverse split volatility. Will ZCMD follow that historical tendency? ZCMD, John Inc. presents a very interesting case study with its incredibly high cost to borrow, extremely limited borrowable shares, and a recent reverse stock split. These factors combined with its microcap status make it one to watch for educational purposes regarding short squeeze dynamics. However, the existing dilution risk means vigilance is key. Always remember to do your own thorough due diligence. If you found this breakdown helpful, please like this video, subscribe to the channel for more unique insights, and let us know in the comments if you have any questions or other stocks you'd like us to analyze.